Every company starts with a simple idea. Let's follow Priya, an entrepreneur with an idea to create eco-friendly designer shoes. She believes the world needs a sustainable fashion revolution. But, like every visionary, Priya faces a challenge: funding her dream. She pools in her savings and gets support from her close friends or angel investors. This initial funding is called seed capital. With the seed fund, Priya sets up a small manufacturing unit and a retail outlet. Soon, her eco shoes are a hit. And now, Priya needs more capital to expand, open more outlets, and increase production. This is where venture capitalists step in, who invest in early-stage businesses with growth potential. As years pass, Priya's business thrives across the country. She now needs major capital to expand her product line. Private equity investors come in to support her in scaling up, taking business decisions, and overseeing the company's functioning. Fast forward a few years, Priya dreams of going global. The capital needed for this expansion is huge, and she decides it's time to go public through an initial public offering, namely IPO. Priya's company offers shares to the public for the first time. By purchasing the shares of her company, investors now own a part of the company. Apart from IPOs, there are different types of issues in market. Priya could have also raised funds through private placements, where securities are offered to a small group of investors. It is often faster and involves fewer regulations than IPOs. Within private placements, there is a preference issue and qualified institutional placement. In preference issues, companies issue shares to a selected group of investors, often to raise capital quickly. While in QIPs, listed companies issue securities to institutional buyers without the usual regulatory filings. A company that is already publicly listed can also raise additional capital by issuing new shares. This is called a follow-on public offering, namely FPO. Besides these, there are rights and bonus issues as well, where companies offer existing shareholders shares at a discount or free additional shares, enhancing shareholder control and rewarding loyalty. This is the power of the primary market, where businesses grow and investors participate in their journey. Plus, when a company decides to go public, it must follow a structured process and steps to ensure a smooth and successful IPO. As an investor, if you are considering investing in an IPO, remember to review the prospectus and offer documents carefully. These documents provide essential details about the company, its business, growth plans, and listing details. You can find this document on SEBI's and NSE's websites easily. To apply through offline mode, all you need is a Demat account to get started. Apply to the issue through various brokers or intermediaries. You need to fill in all the required details and specify the number of shares or lots you wish to apply along with the payment details. For online mode, you additionally need a trading account. Log into your trading account and go to the bid section. Select the IPO you want to apply for. Provide your UPI ID, provide the quantity of shares you want to purchase, enter the price, select the undertaking, and click on Apply. Ensure to accept the UPI mandate on the UPI application. In case you get the share allotment, they will be reflected in your Demat account once the IPO closes. And then, if you wish to buy more shares or sell the existing shares, you can do it once these shares get listed on the secondary market. The primary market connects the government, companies, and other institutions to raise funds through the sale of debt and equity-related securities, fueling the growth that shape the future. Know more about the secondary market in our next video.
सोच कर समझ कर इन्वेस्ट कर